David Keller, he's the president of Sierra Alpha Research, joining us this morning to walk through some of the things on your mind. David, let's begin with the S&P 500. From the bird's eye view, it looked like a pretty solid week last week, but tell me what happens when you dig deeper.
Yeah, I mean, there's no denying that the market's been going higher. And one of my mentors, Paul Montgomery, a legendary technical analyst, always said that the most bullish thing the market can do is go up. So the fact that we continue to see higher closing highs confirms the fact that the market's just in a bullish configuration. That's undeniable. But looking at that second level, looking underneath the hood is where it's an important validation of the uptrend that you've seen. And I'm seeing some things that concern me a little bit, especially in the short term. So the last couple times we've seen a push higher in the S&P, we've seen a bearish divergence from the RSI. And that's what you're seeing, I think, on the bottom of the screen there. And all that is a measure of momentum. So every time the market closes higher, what's the momentum underneath that? How strong are stocks being pushed higher? And what we've seen recently then on this last up move, new closing highs, but a lower high in the RSI. And a lot of times that tells you an internal weakness. The next couple of weeks, I think, could be a little weaker rather than stronger. Some chinks in the armor potentially on the overall market trend.
I know that there is a ton of options for measuring things like breadth and momentum, David, but have there been highs in the S&P 500 that are more powerful, robust than the one we hit at 23 times earnings back in Jan 18? I mean, not to keep coming back to this, but I know that one of the things you point out was 52-week highs as well, and we've talked about that here. Compelling, but on a bit degree less?
I think that's right. I mean, the move out of the lows last December was pretty significant. That initial thrust higher was undeniably strong. I think when you look at things like the 52-week highs, that's an interesting way of sort of validating, what is the average stock doing? Are seeing a lot of participation, a lot of upside participation that's driving the market higher? Or is it more of a narrow leadership sort of situation? What we've seen now is we've seen, clear leadership from the mega caps, the large caps. You've seen a lot of lagging behind from small caps, mid caps, micro caps, which is an area of concern, and the dollar weakness that you got, or the dollar strength that you guys mentioned, I think is an interesting conflict with what we're seeing with weakness in small cap stocks right now. I think that has to resolve one way or the other. But yeah, you'd love to see a lot more 52-week highs than we're seeing right now. The last couple thrusts higher in the S&P, there have been less and less stocks participating on the upside. That's definitely an area of concern for me in terms of long-term health of the market.
A lot has been made of the Russell 2000, but let's talk mid-caps as well. Similar looking chart. Last week, we did finally get some strength in the Russell. How about the mid-sized companies?
Yeah, so one of the, if you look at a relative basis, look at mid-caps, small caps relative to the S&P 500, that's been the biggest area of concern. So while on a price basis, they've held up okay, and they're not really, weakening, it's just they're not moving anywhere near as strong as the large and mega cap names. Now, small caps, a little bit weaker. Mid caps are actually holding up very well, and they're just at a key resistance level. And that mid cap index, I think, is right at the point where you could argue it's setting up a beautiful long base. Breaks to new highs. If that would happen, that would really confirm some upside and confirm some follow through from lower in the cap tiers, which I think we've been missing. So it's been very easy to be skeptical of the recent up move in stocks because you haven't seen participation from mid cap, small cap names. A confirmation, the mid cap index going to new highs this week, I think would certainly confirm some potential upside. That would definitely, I think, maybe weaken the bear's case here.
Now, does your analysis for the smaller and mid-cap companies, is it contained to like that index and those companies themselves, or do you try and take a sort of relationship or any predictive value for what it means in the S&P 500 based on what happens here for mid or small companies?
Definitely. Now, I mean, you have to remember it's what you guys were talking about a little earlier with gold, with the dollar, with the S&P. It's very easy to want to make a simple, comparative relationship between the S&P and the yield curve or something like that. There's so many moving parts in this market right now. And so many potential catalysts, even just this week for stocks. So you've got the, U.S.-China trade negotiations. You've got the Fed. We have all sorts of earnings releases. And we saw in the last couple of weeks, an earnings win, an earnings miss can dramatically change the shape of a chart. So I think there's a lot of potential ways that the market could move up or down. I think when you're looking at small caps and mid caps in particular, it's all about confirmation. And if you see the broad market going higher, you see the S&P seeing higher highs, you would expect small and mid cap stocks to be more leadership than laggership. You would expect the more speculative, more higher beta, more risky names to be leading the way higher. And that's just not what we've seen here. Now, that's not to say that the market can't rally with small caps not participating. That's what we've seen the last couple months. Small caps have been weaker, but the market's done okay. But in terms of an extended, I'm thinking now, we're at highs, making new highs. What do I see for a new leg higher? And for me, that's the area of concern. You'd need to see some agreement with small and mid cap names for me to agree that we could see another leg higher in stocks. Other ways, I think the upside seems limited here.
All right, let's talk some sectors, because what I think is interesting, over the past month, the market has become entirely convinced the cut is coming. For a while there, up until a certain, it was pretty impressive last week. We still had like a 50 bip cut as a 25% chance for a while. But even despite all this talk about how we need to cut to save the economy, the staples have kind of fallen back relative to discretionary names, which is interesting. I know you're looking at this as well the past month, preference by the market for discretionary as opposed to some of the defensive staples companies. So what are you going to be looking at here between this relationship?
Yeah, I love this theme. I mean, looking below the hood of the S&P, looking at some of the sector stories and where we're seeing strength and weakness. One of the things I love to look at is the relative performance of consumer discretionary versus consumer staples. And it's essentially a very pure offense versus defense within the consumer space. Our institutions leaning more towards discretionary purchases and more of the staples, beverages, and things like that. And what we've seen is recently, there was a little pullback in that ratio as the market corrected, but then that ratio has just improved again. And you've seen the discretionary names start to outperform. But if you look at it, it's nowhere near new highs, while the equity market overall, the S&P 500 is. So there's a little bit of a divergence where the market's going higher, but we're seeing less of a confirmation from the consumer space. In terms of charts to watch this week, especially, again, with all the earnings that we see coming on, all the uncertainty, if you would see this ratio start to roll over, it's the kind of thing that would raise a red flag for me, thinking that there might be some weakness. There might be some rotation of money flows, interest sector, moving more from discretionary to staples. So that rollover in that ratio, I think, would be a really interesting tell for overall market health. And what's happened, if you look over history, this sort of ratio a lot of times will lead what you see with the overall market. The ratio will rotate. People will be rotating more towards a defensive posture, and then the overall market will recognize a weaker perspective. So I think it's a really interesting chart to watch right here.
Hey, when you look at a ratio, as we've got up there, do you apply things like, lower highs or any other additional technical analysis once you do a ratio? Do those types of things apply? Because what I do notice is that we do have kind of a series maybe kind of forming here where this ratio, even when it does climb, kind of turns back at lower levels.
You are asking questions like a technician, Oliver, and that makes me very happy.
I'm learning, David.
I love what you're doing. No, but you're absolutely right. I think you have to be careful in terms of what all you do. I've seen people try to do, really sophisticated technical analysis, indicators, and so forth on ratios. I think you have to be a little careful, because for me, the chart always represents behavior. So when you're looking at an individual stock and you apply indicators to it, you're doing that because you recognize that price has meaning. The price being at a certain level has meaning. With ratios, it's all about the movement. So is the ratio going up, going down? Are we at an inflection point? Is market A doing one thing and the ratio doing something different? So when I see the market going to higher highs, but the ratio going to lower highs, that's a really important tell. I think that's a very valid takeaway, because it just tells you that ratio shows you where people are betting one market relative to another, and they're just not moving as much into the one market as you might expect from the overall market strength. Also, something like RSI, I think, is very valid, and a lot of people do very well with pairs trades, looking at two different markets and looking at the momentum of that ratio, just seeing when people get too much on one side or the other of a market.
Got it. Hey, David, real quick, last one, a little bonus chart, because we're going to talk a lot of healthcare, biotech today. What do you think about IBB?
Yeah, biotech is one I would be very careful about, and the reason is this. Again, in a vacuum, if you just look at the price chart, not too bad. It's pulled back to an area of support, and if you look back to the lows from earlier this year, from the end of last year, like we're right about at that point, and also some Fibonacci levels where you'd expect maybe this is the place where I might want to take a nibble. But I think the most important line on this chart is at the bottom, looking at the relative strength of biotech versus the S&P 500. And it's one of those where you might do a really good job picking a good entry point on the chart, but you're not going to get rewarded for it on a relative basis. That relative line going down just tells you there are better opportunities elsewhere. So for me, if I'm looking for places to add money, I'd be looking at places where there's relative strength, places like, spaces in technology, in software names where we've seen some consistent strength, or other areas of healthcare that are starting to improve on a relative basis. Biotech, for me, I think until you see that relative picture improve, it's worth sort of staying on the sidelines until we get some sort of confirmation there.
All right, awesome stuff, Mr. Keller. As always, David, appreciate it. We'll catch up soon.
Sounds good, Oliver. Thanks.
You got it. David Keller is the president of Sierra Alpha Research. Great charts from David.